What's going on, everybody, and welcome back to yet another video. Today I'm going to be breaking down one of the simplest and most reliable trading setups that I personally use every single day. And the crazy part is you don't need a ton of indicators or complicated analysis to use it. This is the exact setup that helps me catch high quality moves within the first 2 hours of market open, and it works across stocks, futures, and even Forex. It's consistent, it's mechanical, and it removes all the guessing from your trades. So here's what I'm going to show you in today's video. First, exactly what this strategy is and why it works so well. Second, the 3 simple steps to execute it. And then third, real examples on how this trade played out. I'm going to show you a breakout, a retest, and a reversal setup, so you can see how all 3 of these setups play out. So grab a notebook, because by the end of this video, you'll have a full blueprint to trade this setup confidently every single day. Now let's hop into it. All right, so I want to start off with why simplicity wins. The biggest problem I see with traders is overcomplication. They're stacking indicators, switching strategies, and second guessing every move. But the truth is, the most consistent traders aren't the ones with fancy setups. They're the ones who master one simple process and repeat it day after day. This opening range strategy is exactly that. It's repeatable, easy to understand, and built around how the market naturally moves when volatility first hits. So what is the opening range? When a new market session begins, like the New York session at 9:30 a.m. EST, the first few candles tell you a ton about where money is flowing. The high and low of that very first candle form what's called as the opening range. The top is where buyers first tried to push, and the bottom is where sellers first started to push back. The zone is packed with liquidity. Institutions, algorithms, and retail traders all engage here. And that's why the breakout of this range often sets the tone for the entire session. Now, you can technically use it in any session, London, New York, or Asia, but in my experience, New York gives the cleanest volatility and the best setups because that's where volume floods in. So first, we always want to identify the overall structure. You want to identify from the higher time frames, is the market bullish or is the market bearish? Now, the reason why this is so important is because when it comes to actually trading your opening range breakout, well, if the market's very weak, ideally we don't want to be looking for a breakout to the upside. Instead, we want to be looking for a breakdown to the downside, and vice versa to the upside. If the market's super bullish, ideally we do not want to be looking to short the market because the market is very bullish. Instead, we would want to be looking for price to break above the high of that opening range to look to go for longs. So again, understanding the overall trend, is it bullish or is it bearish? That is going to help you significantly when trading this strategy. Also, mark any key areas of support and resistance or supply and demand, because this strategy isn't as simple as going long on the break above the range or going short at the break below the range. If you're going long or short into a key level, there's a very high probability that you are going to lose. So again, mark your higher time frame key levels and make sure you are not trading the opening range breakout into that key level. So now here's the 4-step process for the setup. Number 1 is you want to mark the opening range. Now, as far as the opening range, there's many different time frames that you can use to trade this. Some traders trade the first 5-minute opening range. Some traders trade the 15-minute opening range. I'm a big fan of the 30-minute opening range. But essentially find the high and low of that first either 5-minute candle, 15-minute candle, or 30-minute candle, and mark that high and low. Let me actually show you on the chart. So if we're looking at the S&P futures, this is the 5-minute time frame. If you were to trade the 5-minute opening range breakout, you would simply find that first 5-minute candle of market open, mark your high, and then mark your low, just like that. If you traded the 15-minute opening range, again, find that first 5-minute candle, and then find that third 5-minute candle and mark the high and low. Or just go to a 15-minute time frame and mark the high and low. But like I said, I'm a big fan of the 30-minute opening range, so I'll wait for that first 30-minute candle to close, mark the high, and then mark the low, just like this. Next, we are waiting for price to either break above or below the range. Again, after identifying the overall trend, if we can get a strong breakout or breakdown, I will look to go long or short. Or if I end up missing the breakout or breakdown, I will look for price to come back and retest that opening range for a potential entry. Or if it tries to break and fails it and comes back down within the range, I'll actually look for a reversal trade. Again, we always want to confirm with a clean candle as far as an entry and an exit, and then simply just execute the trade. So let's go ahead and head back to the chart. So today, for example, if we were trading the 30-minute opening range breakout, this is our first 30-minute candle. As soon as it closes, we are going to mark the low and we are going to mark the high. Now what we are waiting for is for price to either break above this opening range to look for longs, or for price to break below this opening range for shorts. If price breaks above the high of this first 30-minute candle with a lot of strength and volume, we can look to trade the breakout to the upside with a stop loss set right below the breakout point. Or if price were to break below the opening range, again with a lot of weakness and volume, we could look to go short with a stop right above the breakdown. Now, if for whatever reason we end up missing the breakout or breakdown, maybe we hesitated, maybe we weren't looking at that time, we can look for price to come back up and trade the breakdown or breakout point, and we can either look to go long or we can look to go short. So if we were to retest the high of this opening range, we would look to go long. Again, we would stop out if price were to break below the high of that opening range. Or when price came back and retested the low of the opening range, we would look to go short. And again, stop loss would be if price reclaimed that previous low. But the third option to trading this is if we fail to hold this breakout and we come back into the range, we can actually look to short this and take it back down. Or if price fails to hold below the range and comes back and retest it, we can look to go long and take price higher. So again, a few different ways that you could trade this. Now here's my secret sauce to trading this strategy and any strategy in general. I don't trade unless all my criteria is met, and I let the market come to me. I do not chase the market and I do not force trades. So if we were to look at today's example, because I think today actually offered a really good 30-minute orb, mark the high and low of that first 30-minute candle. And then when I'm looking for my entries, I'm either breaking price down to a 5-minute time frame or a 2-minute time frame. So now as we can see, we eventually break below this 30-minute opening range right here, and we really start to flush. So a lot of weakness on this move down right here. This would be an example for when I'm looking for price to come back up and retest this previous low of that 30-minute opening range. And now what I would do is I would go short and my stop loss would be right above this previous high. So say you ended up going short right here, you're risking about like 4.5, 5 points, give or take. I'm usually always looking for at least a 1-to-1 risk to reward. So I'll just put the 1-to-1 risk to reward at 5 points here. And then you can see on that very next candle, you hit your 1-to-1 risk to reward. So typically what I would do at this point is I would trim my position and I would put my stop loss at break even. That way, worst case scenario, you already made a little bit of money. Best case scenario, it continues to roll over and die and go even lower. So that's what you would look for if price were to break the opening range and come back and retest it. But what about those times when we get those false breaks? So here's the low of that first 30-minute candle. Price tries to break it later in the day. It breaks below it, but comes back up and it reclaims it with a lot of volume, as we can see right here. Now, when you see that, that is typically when you would be looking to go long. And again, your stop would be set right below here. So for me, I would either be going long at the close of that 5-minute candle, or if price were to pull back and give a better risk to reward, because again, your stop would have to be all the way down here. So it depends on your risk tolerance. But again, I would be looking to go long somewhere in this general area. Stop loss would be weakness below this confirmation candle. And as you can see from there, price made a very quick and aggressive move into a new high a day. So that's the second way that I would look to trade this. Here's actually another really good example, the break and retest. Price breaks below the low of that first 30-minute candle, comes back up later on, retest it right here. You're looking to go short in this area, stop right above there, boom, very quick and aggressive move down. Here's actually a good example to the upside as well, and actually the false break as well as a continuation. We try to break above it here, false breakout, go short, stop right above here, travels to the other side of the range pretty much. Then here we get a break above that 30-minute opening range, comes back, retest it. Here's your confirmation candle. Your stop is going to be weakness below this confirmation candle, which you never got that weakness. So regardless if you went long here or on the reclaim here, again, a nice long lower wick, that would be confirmation for me. Again, stop loss is somewhere down here with weakness, and you can see we caught a nice move to the upside. But the final way that you can look to trade this is on the breakout above or below that range. Now, typically, if I'm going to do this, it is 100% a scalp. If we get more in the trade, awesome. But ideally, I'm looking to scalp it, move my stop loss to break even, and then again, either capture a larger move or stop out the rest at break even. So I'm looking for price to break above or below that opening range with solid confirmation. This is a pretty bullish candle going right through the high of that opening range breakout. So as a result, I would be looking to go long at this candle close, or if order flow were to tell me to get in before the candle close, again, stop loss would be if price were to fail to break above and hold this area. And I'd be looking for bare minimum a 1-to-1 risk to reward, which you can see we very clearly got right here. But now here are some key takeaways from this video. Simplicity is always going to beat complexity. Structure plus confirmation is going to give you the confidence you need when trading, and one clean trade a day can change your results forever. So if you guys did find value in today's video, make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. And if you guys are looking to get funded, make sure to check out Take Profit Trader and use discount code Brandon in all caps. It'll get you 40% off your accounts as well as no activation fee. Other than that, everybody have an amazing rest of your day. I'll see you guys in the next video.